The paycheck hits right on schedule, every 2 weeks, like clockwork. Numbers update in the bank account, bills get paid, groceries are covered, subscriptions quietly renew in the background. Life moves forward in a steady rhythm. Nothing feels broken, nothing feels urgent. It all feels stable. That sense of stability is exactly where the trap begins, because everything in that system depends on one single event repeating over and over again. One deposit, one employer, one stream of income holding everything together. And almost nobody stops to ask the uncomfortable question: what happens when that single deposit stops? Now, before getting into this, quick introduction. This is Ajaz, with a background in finance and years spent studying how money actually moves in the real world, not just on paper. And one pattern shows up again and again, no matter the income level, no matter the lifestyle. People don't fail financially because they don't earn enough. They fail because everything depends on one source. What happens when that single deposit stops? Not slows down, not gets reduced, completely stops. That's where the entire structure starts to show cracks. There's a version of this story that plays out every single day, and it usually starts the same way. A steady job, a decent salary, not rich, not struggling, just comfortable enough to not worry too much. Take someone like David. David earns about $75,000 a year. Solid income, not extravagant, but enough to support a family of 3. There's a mortgage tied to a house that felt like a milestone when it was signed. A car payment that blends into the background like any other bill. Groceries, utilities, insurance, streaming services, school expenses. Everything fits neatly within that monthly budget. On paper, it looks responsible. Money comes in, money goes out. Nothing dramatic. But underneath that calm surface, there's something fragile holding it all together. Because every single expense in David's life is anchored to one assumption: the paycheck keeps coming. Then one day, it doesn't. No warning that feels real enough. Maybe a meeting, maybe a restructuring, maybe a quiet email. However it happens, the result is the same. Income drops to zero. The first few days don't feel like a crisis. There's still money in the account. There's still time. There's confidence that something new will come along quickly. After all, there's experience, skills, a decent resume. But time moves faster when money isn't coming in. Within 30 days, the numbers start shifting. Savings get tapped for the first time. It doesn't feel catastrophic yet, just temporary. Within 60 days, the emergency fund starts thinning out faster than expected. Bills don't pause just because income stopped. Mortgage stays the same. Car payment stays the same. Grocery prices don't suddenly drop out of sympathy. Within 90 days, the pressure changes tone. It's no longer about convenience. It becomes survival math. Within 120 days, something breaks. A missed payment, a delayed bill, a decision that would have seemed unthinkable just a few months earlier. This isn't a rare situation. It's a predictable one, because the real problem isn't just losing a job. The real problem is that the entire financial structure was built on a single point of failure. That's the part nobody talks about enough. There's this idea that having a job equals security, that a stable salary equals safety, that as long as income is steady, everything else will take care of itself. But that belief ignores how fragile a single income stream really is. It's like building an entire house on one pillar and hoping nothing ever happens to it. Now contrast that with someone like Rachel. Same salary, same starting point, around $75,000 a year. Similar lifestyle on the surface, but the structure underneath is completely different. Rachel still has a job, still receives that steady paycheck, but that paycheck isn't the only thing holding everything together. There's a small rental property bringing in around $1,200 a month. Nothing massive, but consistent. There's also a digital product generating another $800 a month. Something built once and maintained over time. Those numbers might not sound life-changing individually, but together, they tell a completely different story. Because now, income isn't coming from one place, it's coming from multiple streams that don't all depend on the same thing. Then the same scenario happens. The job disappears. Same timeline, same situation, same external shock. But the outcome looks very different. Rachel doesn't drop to zero. Instead of going from full income to nothing, there's still around $2,000 a month coming in. That's not enough to maintain everything exactly the same, but it covers a significant portion of essential expenses. Roughly 70% of the core costs are still being handled automatically. That changes everything, because now time works differently. Instead of a countdown toward financial collapse, there's breathing room. Decisions can be made from a place of control instead of panic. Investments don't need to be liquidated at the worst possible moment. Debt doesn't spiral out of control just to stay afloat. This is the difference between income concentration and income diversification. It's not about being rich. It's about not being vulnerable. And yet, most people are unknowingly building their entire financial life around a single source of income. That's the real ticking time bomb. There's a deeper reason this happens, and it starts early. From a young age, the message is clear. Study hard, get good grades, land a stable job, build a career. That's the formula that gets repeated over and over again. And to be fair, that formula does work, to a point. It creates income, it creates structure, it creates a sense of progress. But it also creates dependency, because nowhere in that system is there a strong emphasis on building income redundancy. There's no real conversation about what happens if that one job disappears. No real strategy for creating multiple streams of income that can support each other. So the default path becomes obvious. One job, one paycheck, one financial lifeline. The problem is, the world doesn't operate on that level of predictability anymore. There are forces at play that no single individual can control. Interest rates shift. Inflation rises. Entire industries evolve or shrink. Technology replaces roles faster than expected. Companies restructure without warning. None of these things ask for permission, and when they hit, they don't care how stable things looked before. There's a growing awareness of this reality. In 2026, a significant percentage of Americans identify job loss or income uncertainty as their top financial fear. That fear isn't irrational. It's rooted in a system where a single disruption can trigger a chain reaction. Because once income stops, everything tied to it starts to unravel. Bills don't adjust themselves. Debt doesn't disappear. Expenses don't pause. And if there's no backup, no secondary flow of income, the entire financial structure becomes reactive instead of proactive. That's where many of the other financial mistakes start to show up more clearly. Take the idea of treating salary like a spending limit. It feels natural. If $6,000 comes in every month, it's easy to build a lifestyle that uses most of it. Not recklessly, just gradually. A slightly better apartment, a newer car, more subscriptions, small upgrades that feel justified. Over time, that becomes the new normal. But that normal is built on the assumption that income never changes. So when it does, the adjustment isn't small, it's abrupt and painful. Then there's the paycheck timing issue. Money comes in and gets spent almost immediately. Not because of poor discipline, but because the system is designed that way. Bills are scheduled, expenses are predictable. There's no buffer built into the flow, so every cycle starts fresh, with little margin for error. That's how people can earn decent incomes and still feel like they're constantly catching up. Then add in high-interest debt. Credit cards become a temporary bridge, just for flexibility, just to manage timing, just to handle unexpected costs. But those balances don't stay small for long. Interest rates climb. Minimum payments stretch the timeline. What felt manageable starts compounding into something heavier. And every dollar going toward interest is a dollar that isn't building anything for the future. It's a quiet transfer of wealth in the wrong direction. At the same time, there's another subtle issue happening with cash. Keeping money in a basic checking account feels safe. It's accessible. It's visible. It creates a sense of security. But if that money isn't earning anything, it's slowly losing value. Inflation doesn't need to be dramatic to have an impact. Even a few percentage points each year quietly erode purchasing power. So while it feels like money is being saved, it's actually shrinking in real terms. That creates a strange paradox. There's a need for liquidity, for accessible cash in emergencies. But there's also a need for that cash to do something instead of sitting idle. Balancing those two becomes critical. Then there's lifestyle creep. This one is less about numbers and more about psychology. Every raise feels like progress, and it is. But that progress often gets absorbed immediately into higher expenses. A better place to live, a nicer car, more convenience, more comfort. None of these are inherently bad. The problem is when they scale at the same rate as income, because then, despite earning more, nothing really changes. The margin stays the same. And without that margin, there's no room to build anything beyond the present. All of these patterns feed into the same core issue: cash flow management. The paycheck hits right on schedule. Every 2 weeks, like clockwork. Numbers update in the bank account. Bills get paid. Groceries are covered. Subscriptions quietly renew in the background. Life moves forward in a steady rhythm. Nothing feels broken. Nothing feels urgent. It all feels stable. That sense of stability is exactly where the trap begins, because everything in that system depends on one single event repeating over and over again. One deposit, one employer, one stream of income holding everything together. And almost nobody stops to ask the uncomfortable question: what happens when that single deposit stops? Now, before getting into this, quick introduction. This is a Jazz, with a background in finance and a focus on how money actually flows in real life, not just on paper. One pattern keeps showing up. People don't struggle because they earn too little, but because everything depends on one source. It's not just about how much money comes in. It's about how that money moves, how it's allocated, and how much of it is protected over time. And when everything relies on one paycheck, one disruption can ripple through everything. That's where the real risk begins. Then there's the issue of cash flow visibility. Many people track their finances monthly. Bills are reviewed, accounts are checked, adjustments are made. But by the time something shows up on a monthly statement, the opportunity to prevent it has often already passed. Wealthier individuals tend to approach this differently. There's more frequent awareness, daily or weekly check-ins. Not obsessive, but consistent enough to stay ahead of problems instead of reacting to them. That shift from reactive to proactive management changes how money behaves over time. It also changes how quickly issues can be corrected. Then there's the concept of automation. Relying on leftover money to save or invest rarely works, because if money is available, it tends to get used. Not necessarily irresponsibly, just naturally. Automation removes that friction. When money moves into savings or investments before it's seen as spendable, it changes the entire dynamic. It creates consistency without requiring constant decision-making. And over time, that consistency builds momentum. This ties back into the idea of building income streams as well, because most additional income sources don't start big. They start small, sometimes almost insignificant. A few $100s a month, maybe less. But those small amounts aren't the end goal. They're the beginning of a system that can grow, adapt, and eventually reduce reliance on a single paycheck. There's also a mindset shift that separates those who build multiple income streams from those who don't. It's the difference between seeing income as something earned only through time and seeing it as something that can be created through systems. A traditional job is linear. Time is exchanged for money. More time, more income. Less time, less income. Additional income streams often break that pattern. A rental property generates income whether or not active work is happening every day. A digital product can sell repeatedly without being recreated each time. Investments can generate returns independently of daily effort. These aren't instant solutions. They require effort up front, sometimes significant effort. But once they're established, they begin to operate differently than a standard job. And that difference becomes critical in moments of disruption. Because when one source of income stops, others continue. That's the safety net that most people don't realize they're missing until they need it. There's also a psychological component that plays a role here. When income comes from a single source, there's often a higher level of dependence on that source. Decisions become more cautious. Risk tolerance decreases. Opportunities that might lead to growth get passed up because the downside feels too significant. Multiple income streams create a different mindset. There's more flexibility, more willingness to explore opportunities, more confidence in making decisions that aren't entirely dependent on one outcome. That doesn't mean reckless behavior. It means calculated flexibility. And over time, that flexibility can lead to better outcomes. Now, bringing this all together leads to a framework that simplifies the concept. Think of income not as a single stream, but as a stack. At the base is active income. This is the job, the primary source. It's usually the largest and most immediate. Above that is supplemental income. Side work, freelance projects, small businesses. These require effort but can scale beyond the limitations of a fixed salary. Then comes semi-passive income. Things like rental properties or digital products. They require setup and maintenance, but not constant daily input. At the top is passive income, investments that generate returns over time, dividends, interest, long-term growth. Each layer serves a different purpose. Active income provides stability in the present. Supplemental income adds flexibility. Semi-passive income creates leverage. Passive income builds long-term security. The goal isn't to jump straight to the top. It's to build gradually, to move from one layer to the next while maintaining balance. Because even adding one additional stream can significantly reduce vulnerability. Even a few $100s a month can change how financial disruptions are handled. That's the part that often gets underestimated. It doesn't require replacing a full salary overnight. It starts with reducing dependency step by step. And over time, that reduction compounds into something much more stable. Because the real risk was never just about losing a job. It was about having nothing else when that happens. That's the ticking time bomb. Not because something will definitely go wrong tomorrow, but because if it does, the impact is immediate and severe when everything depends on one source. The solution isn't complicated, but it does require a shift in how income is viewed. From a single line to a layered system, from dependency to redundancy, from reaction to preparation. Because in a world where so many factors are outside of control, the structure of income is one of the few things that can be designed intentionally. And that design determines whether a disruption becomes a setback or a collapse. So the real question isn't whether a single paycheck is enough today. It's whether it would still be enough if it disappeared tomorrow. That's where the answer changes everything. And that's where the work begins. If this breakdown shifted the way income is being viewed, then it's worth taking it one step further. Subscribe to the channel for more deep dives like this, where complex financial ideas get broken down into practical, real-world strategies. Drop a comment with which part of the income stack feels most realistic to start with right now. And share this with someone who's still relying on just one paycheck without realizing the risk.